Taking a hard look at market history and what transpired in 2015 will help us answer the question regarding 2016. Is a sharp move coming in stocks? To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. We have a tremendous amount of information to cover, therefore we'll be moving quickly. If you want to look at more detail on any slide or any chart, you can use the pause button in the lower left-hand corner of your video player. Major topics, 2016 investment scenarios. We'll look at some periods that we have not examined before. Talk about the model in 2015, a major wild card for investing over the next few years. We'll cover numerous charts that can help us with these 2016 investment scenarios. Annual returns are extremely important, but it's also important to understand them in the context of a full market cycle and what the model focuses on, which is the miracle of compounding. As we walk through a full market cycle, some of these comments will be put in a different context. Shorter-term focus, longer-term focus. Risk-adjusted returns means we ask two questions. How do we do relative to the market? And how much risk did we take in an attempt to beat the S&P 500? It's not a question of if a bear market is coming. It's just a question of when. And when a bear does arrive, questions that were asked in this context start to become a little bit less relevant as the losses pile up. If we forget about risk management and only focus on the short term, we may end up giving back all of our gains, which is very, very common in the stock market. If we were getting ready to retire or 11 years into retirement, it would be awful disappointing to give back 11 years of gains. That can happen if we don't have a risk management strategy. Therefore, the CCM market model focuses on the full cycle, a full bull market and a full bear market. It doesn't do us much good to outperform the S&P 500 or even make money if we're going to give it all back. The market model is constantly focusing on the miracle of compounding and the full market cycle. The little things that we do along the way should enable us from a probability perspective to outperform the market over that full cycle. This historical example can help us tie some of this together. We have a period here where the S&P 500 makes almost no progress for 2 years. Sound familiar? The market lost money, gave it back at the end of the year. Sound familiar? And we had a very, very volatile year. Let's assume that we underperformed the stock market by 8% over this 12-month period. By focusing on probabilities and risk reward, the CCM market model also attempts to leverage opportunity costs. In this case, not only did the stock market fall 41% over the next 647 calendar days, but we also have to consider that capital tied up in stocks, when stocks were dropping 41%, also had an opportunity cost component, because over the exact same 647 days, long-term treasury bonds, think TLT, gained 21%. That's a difference of 62% when we consider that potential opportunity cost. Now let's shift gears to the Fed and the day that they raised interest rates in December. On December 16th, the Fed raised the federal funds rate or interest rates by 1/4 to 0.5%, which provides a nice segue into the major investment scenarios. On one extreme, low rates have artificially inflated asset prices in the economy. When interest rates start to rise, it will hurt both stocks and the economy. Therefore, safe haven bonds will significantly outperform stocks over the next 15 years. The other extreme has backers as well, and that's why the markets have been so indecisive. The Fed is raising interest rates because the economy has improved. Rising rates will be a drag on bonds. An improving economy and rising rates mean stocks should significantly outperform bonds over the next 15 years. The middle of the road opinion also has logical backing on Wall Street. We expect a continuation of 2015 into 2016, aka another lackluster year with markets moving sideways. Regular viewers and clients know that our approach is not to forecast and to keep a flexible and open mind. Therefore, can we learn anything from forecasting in the past and history relative to the three major investment scenarios? Forecasting is difficult and the long-term track record is not good. 2015 fits that profile. 13 top Wall Street pros in their forecast for 2015. Average gain projected almost 8% for the S&P 500. Actual lost almost 1%. Did any of them predict a red year? No. Did any of them hit their year-end target? No. 13 for 13. If we look at interest rates dating back to 1980, this chart looks pretty ominous. Taking the same chart back to 1954, we can learn some things. Present day is here. You can barely see it because rates have basically been at zero. This is extremely odd, and we have to respect that. However, we do have historical cases, A, B, and C, where interest rates rose from historically low levels. If we look at asset class performance, we have some similarities to the present day when interest rates were rising here from historically low levels. The similarities are not surprising because we're talking about human beings with greed and fear. Point A is 1954 when rates started to rise from a historically low level. Prior to that, the S&P 500 had 3 years of impressive gains and then a relatively flat year. This is very, very similar to the market's profile in the present day. We had gains and then a relatively flat year. These lows and these years correspond to A, B, and C when interest rates rose from historically low levels, giving us potentially some insight to the present day. In terms of the three investment scenarios, the one that played out historically here is the scenario of an improving economy and that stocks will outperform bonds. This is low A, low B, low C. Interest rates rising from historically low levels. How did stocks do from this point here, point A? Stocks, the cumulative return from 1954, point A, to 1968 was 232%. 10-year bonds lagged significantly. They gained roughly 32% over the same period. What's the takeaway here? The takeaway is this helps us keep an open mind about better than expected outcomes from a flexibility perspective. Some of you may have noticed this 232 here really should be 200% because that's the proper delta. Under our system, we want to maintain maximum flexibility. Therefore, we need to look at both sides of the coin. Let's now shift gears to the glass half empty. Talked about this recently, 100-week, rolling over. We have a vulnerable look here. This chart also classifies as a piece of evidence that will help us in terms of monitoring risk in which scenarios may be playing out. From a concern perspective, from similar points here, the S&P 500 lost 54% and 48% in 2000 and 2008. And we know from a miracle of compounding and opportunity cost perspective that a 54% loss requires a subsequent gain of almost 118% just to get back to break even. The inflection point look of the model and asset class behavior over the last 12 months tell us to keep an open mind about worse than expected scenarios. You can make an argument that we may be in an area like this, even from point A to point B. The S&P 500 lost an additional 53%. From an opportunity cost perspective, the S&P 500 or stocks were out of favor for a whopping 930 calendar days from the year 2000 till October of 2002. 2011 analogy we noted way back on June 15th that we might be in store for a waterfall decline. That was helpful. What was difficult was this. Typically, when you get a waterfall decline, the market falls 19%, somewhere in there. It tends to be a bigger correction when you see something like this. If we fell 19% in 2015, we would have moved to 1728 on the S&P 500. We got nowhere close to that. 1867 was the low, so that was odd. We did execute well. Even knowing this, we still maintained that maximum flexibility. After mentioning the 2011 analogy around mid-year, how did the rest of the year play out? Well, Ryan Dietrich's chart, here's his Twitter handle, helps us answer that question. This is 2011, the S&P 500, where my cursor is, and this is the path of the S&P 500 in 2015. Therefore, it was helpful, and this also tells us that the 2011 analogy, which would be a bullish analogy, is still on the table and leaves a crack in the bullish door. As we demonstrated earlier in the video, stock market forecasts tend to be unhelpful rather than helpful. Therefore, if we pay attention and keep a flexible and open mind, we're probably in better shape. The 1994 analogy helps us keep an open mind about better than expected outcomes. This is from a March 30th article. Did the 2015 stock market kill this analogy between March and the end of the year? Leveraging another great piece of work from Ryan Dietrich, he is showing here how difficult 2015 was even for diversified investors. A portfolio of stocks, bonds, commodities, and cash typically will finish in the green, as you can see looking back 30 years. There are some exceptions, and they align with the inflection point theory. Why? The performance of portfolios tells us a lot about investor conviction, the health of the economy, supply and demand, you name it, it's baked into these returns. 1994, this type of portfolio finished roughly flat for the year. That is very, very similar to 2015, telling us there was indecisiveness in 1994, and we have similar indecisive behavior in 2015, leaving the 1994 scenario on the table. For the bulls, that's good news, because after a painful 1994, the S&P 500 went up 37%, almost in a straight line. After difficult periods, easier and more discernible trend-based periods tend to follow. The performance of the diversified portfolio looking back 30 years also tells us how difficult this year was. Typically, this type of portfolio makes money, telling us that there was some place to hide if stocks weren't doing particularly well. Red in 1994, red in 2001, 2002, 2008, and 2015. These are all inflection point periods. This table helps us keep that flexible and open mind about all outcomes. Ryan showed us that a diversified portfolio was roughly flat in 1994. The S&P 500 here was also nearly flat, very, very similar to the full year return for the S&P in 2015. Notice what happened next. 1995 up 34%, 1996 a 20% gain, 1997 a 31% gain, 1998 26%, 1999 20% roughly. Are we saying that we're expecting returns like this? No, we're not saying that at all. But this does help us keep an open mind about better than expected outcomes. We showed earlier in this video that we wrote about the 2011 analogy in June of 2015. Why was it not more helpful? We'll answer that question with some charts. 2011, we break support here, which is similar to what happened in 2015. But notice the next day was a bullish day. We finished green, and then it took 7 trading days after the break to get to the first low. And then it took 63 days to get the intraday low for the correction, giving the model time to add value. How does that compare to what happened in 2015? From a risk management perspective, this is the oddest thing and the most frustrating thing that happened in 2015. 2011, you have 63 calendar days to add value. 2015, the S&P 500 made the intraday low for the year 2 trading days after support was broken, making it very, very difficult for the model to add value. This is extremely rare to make a low during a waterfall decline, which is basically what happened in 2015. From a risk management perspective, the 2010 flash crash correction now looks like a walk in the park compared to 2015. 117 days from the flash crash to the retest of this low, and it took 56 calendar days after the crash to make the intraday low for the year. 56 versus 2 for 2015. In 1998, there was time to add value. After support was broken, the intraday low for the year did not come for 65 calendar days. Contrast that with 2 trading days for 2015. Let's shift gears now and look at ETF and blue chip stock performance in 2015. This video clearly establishes that there were not many profitable investments in 2015. Did the CCM market model correctly identify the very limited pockets of opportunity? The answer is yes. There were a handful of ETFs and sectors that were green for the year. Unfortunately, out of these 19 leadership ETFs, the average gain was only 5.71%. And when we take that in the context of risk-adjusted returns, meaning how much risk did you have to take to capture that 5.71% gain, it's still questionable. But the good news is these are your leaders. Clients will recognize many of these symbols and sectors. The security selection portion of the CCM market model did an outstanding job identifying those very limited pockets of opportunity. And in the future, when there are sustainable trends, either up or down, that security selection process will pay dividends. Our conclusion this year is that the market model did what it was supposed to do in terms of how it was designed. Another area where it worked as anticipated. We follow numerous ETFs in the model. 86 of them here lost an average of 22.34%. For the most part, the model avoided these horrible places to be in 2015. Buy and hold with safe blue chips didn't work out particularly well for many people in 2015 either. These are all S&P 500 stocks. 217 of them lost 5% or more in 2015, and the average loss for these 215 safe blue chip stocks in 2015 was an unbelievable negative 24.09%. There were so many blue chippers down more than 5% in 2015 that we could not fit them on one page. This is 61 through 120, 121 to 180, and 181 to 217. Another unbelievable stat. If we look at the 100 worst performers for 2015 in the S&P 500, their average loss was 36.53%. It's prudent to look at returns on a risk-adjusted basis. Here's another good sign for the long term for us. Here's where the stock market plunged in August of 2015. The market's risk exposure here in this vulnerable state is 100%. On the same day, our exposure to the stock market was already down to 25%. We had 31% in cash and 44% in either bonds or currencies. Why is that good news? It tells us that if we did morph into a bear market here, the model would have done what it's supposed to do. Have us lose less in the early stages and eventually try to migrate to assets that will limit losses and/or make money. Contrast this exposure to our exposure coming into the year, which was 89% stocks. As the data and facts started to deteriorate, the model started to cut risk. If this bearish profile morphed into a bear market, would we have been on track for the first objective, which was to lose less? Yes, the maximum drawdown from here to here for the broad stock market was 15.5%. Our drawdown on the same exact day was 7.3%, and we were already much better positioned from a risk-reward perspective. This type of execution and migration will absolutely positively pay dividends at some point in the future. Clients know that the market model tries to allocate to defensive assets when the stock market's not doing particularly well. Another huge difference between 2015 and 2011. 2011, there was a place to hide. TLT was up 34%. IEF, intermediate treasuries, up 16%. Gold up almost double digits. Oil up 8%. And a diversified basket of bonds, AGG, up 7%. The average gain when the S&P 500 was flat for these assets was 14.8%. How does that compare to 2015? The identical group of ETFs, they lost 8.8% in calendar year 2015. Contrast that with the 14.8% there were places to hide gain in 2011. Continuing with the nowhere to hide theme, defensive AGG or diversified basket of bonds, discernible trend that the model can see from a hard data perspective. The same chart looks like a whipsaw, indecisive, and confused mess in calendar year 2015. The model helped us stay away from gold. This is gold in 2015, GLD, not a particularly attractive place to be. This is from an October 19th post on Short Takes. Basically said gold has some work to do. We need to see more. The charts, the model, and the data were helpful. Same chart in 2011, gold, like bonds, gave us a place to potentially hide. Step 1, identify a probabilistic low. Step 2, discern between volatility to ignore and volatility to respect, which would be step 3. This is a clean looking chart. This is a downtrend with a lot of whipsaw action in between. It's not unusual during bad years for defensive assets to turn early. 2011, the stock market doesn't plunge until July or August, and yet defensive treasuries start to trend in a discernible manner in Q1. Contrast that with the slope of the TLT point to point in 2015. Returns in the commodity complex were also ugly for 2015. The CCM market model monitors and can allocate to currencies. Unfortunately, strategies based on interest rate differentials were down 13% in 2015, telling us currencies did not really offer a place to hide either. You could make the argument that the odd behavior in 2015 tells us that the stock market is broken and therefore your model is broken. We would beg to differ. The stock market is actually acting quite rationally given the fact that the Fed has kept interest rates suppressed at zero for so long. As we outlined in this short takes post earlier in the year, it is not unusual for the markets to act very odd and indecisive at the front end of a new Fed rate hike cycle. You can find this analysis by Googling this title. Earlier in 2015, you'll remember we covered this slide. This is 2015 here. The Dow moves sideways in a manner never seen before in its entire 115-year history. This is frustrating, but you don't want to build a model around something that happens only every 115 years. By this metric or measure, the plunge that occurred in August of 2015, we hadn't seen something like that for 75 years. Back in July, we covered skepticism, new record never seen before in 2015. 2015 also posted the worst August for the Dow in 17 years. Let's assume that we were running a risk management strategy in a given calendar year and we underperformed the S&P 500 by 5 to 8%. How quickly can underperformance be recaptured once a bear market arrives? The answer for these is 1 day. These are the largest percentage losses all time for the Dow. The highest percentage loss in 1 day is 22.61%, all the way down to the top 20, which is really roughly in the neighborhood of 7%. Putting all of this underperformance in some context when we think of the full market cycle. High yield bonds, how concerned should we be? We're going to look at correlations. These are some extreme examples to help us understand correlations. This line here is the correlation between the Vanguard 500 fund, which is basically an S&P 500 fund, and the S&P 500 itself. You can see it's a very, very strong and consistent correlation. Therefore, if I saw something on a chart of the Vanguard 500 fund, it probably would be helpful relative to the S&P 500 because they zig and zag together. Correlation between the NASDAQ and the S&P 500. It's high and consistently high. And you can see the weekly correlation between high-yield bonds and the S&P 500 is not helpful at all. In fact, sometimes it can be harmful. Under our approach, there are more effective things to monitor relative to the health of the S&P 500. With the Fed changing interest rates, is it helpful to track the money supply? These are three common measures of the money supply. If they are helpful, we want them to look like these lines here, which is the correlation between the NASDAQ and the S&P 500. So let's take a look behind door number 1, door number 2, and door number 3. Under our system, we would classify all three of these money supply indicators as not helpful, especially since they fall into negative correlation territory from time to time. This is the rate of change for M2 here monthly. Can stocks go up when the rate of change is falling? History says yes, 243% gain in the S&P 500 during this period. The wild card for investing in 2016 and going forward is inflation. Right now, expectations looking back 5 years are tame, but we need to keep an eye on this measure. If the market dealer throws out that inflation wild card in 2016, it's good to keep in mind that the CCM market model does not automatically allocate to anything, including bonds. All investments must clear mathematical hurdles, and the model can use cash as a position. The VIX represents one of the charts that can help us discern between the major scenarios in 2016. This is the VIX weekly in 2007. You can see there's a big spike in fear here in 2008, and the worst part of the bear market comes after that. In the present day, we have somewhat of an indecisive look. The bears want the VIX to move here. The bulls would prefer to see it trend in this direction. In terms of where the S&P is and the markets are as of December 31st, not much has changed here, and we don't really need to cover it. We're in the same range that we've been in since October. We'll learn something if we move into this area here, or if we break out into this area here. Right now, all three major scenarios are still on the table. Did the stock market single us out in 2015? The answer is a definitive no. Everybody had to deal with a difficult market. Bloomberg, December 28th. It's the worst year for asset allocation funds since 1937. That means you have to go back 78 years to find a year as difficult as 2015. CNBC covered the same basic topic with this title: 2015 was the hardest year to make money in 78 years. Hedge funds had a difficult year. Even Warren Buffett was down 11%. Markets go through difficult periods from time to time, and it's best to focus on what we can control: our methods, our execution, our discipline, our attitude, our composure. Doesn't mean we shouldn't take a critical look at what we're doing. It's part of our continuous improvement process that we discussed last week, always going through what-if scenarios, including what happens if 2016 is another sideways year. As we discussed last week, we're looking at tools that will enable us to study the markets more efficiently going forward and faster. We want to make decisions based on facts, not an overreaction to a difficult year, continuing to keep a full cycle focus with realistic expectations about how markets work. If we want to have a high probability of producing superior long-term results, we have to think differently than the average investor. And that's where the discipline, the facts, and the model come in, allowing us to push human emotions and the common mistakes aside. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog, Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.